Hi, Harry here with the Rant on September 5th. Non-farm payroll just came in this morning, 22,000, continuing a slide since 2021-22, okay? This is not a good sign, obviously, okay? But what do the markets do? The markets futures are up this morning, particularly the NASDAQ, the more racy tech index, okay? What that's saying is, the Fed's about to make interest rate announcements or decisions, and now they know, they'd say, oh gosh, with this weak number, for sure, they're going to cut rates from 425 and probably maybe as much as 50 basis points instead of 25 basis points now. So the market takes bad news as good news, and that's no surprise. But here's the bigger picture, okay? And Ray Dalio is somebody I get to speak with every year at Tony Robbins' Winter Platinum Group Conference. And he just came out recently, and he's a little more balanced and conservative than I am, and he said, the economy is heading for what he called a debt-induced heart attack. Perfect way to say it, okay? And then he's saying, this should start in the next 3 years. It's been building up, but you know what I say? I say this is already 5 years overdue. We should have seen this second crash to follow 2008 and 9 in 2020 to 22. When the Gen X demographics were still down, and that would have been a much better time for this to happen. But of course, $29 trillion in stimulus starting in 2008 and going up ever since then says otherwise, okay? The real question right now is, though, why has the economy not slowed more? Even though this is slowing, okay, and that's a good sign. Finally, reality is sinking in. But why is it not slowed more with a cut of 2.3 trillion off the 8.9 trillion largest balance sheet ever, okay, and a 525 basis point rate hike from zero? That normally on a lag into late 2024, 25 should have slowed the economy substantially, and here we see it only slowing modestly, okay? Well, my answer to that is simple. It's the millennial spending wave. Why have we had this big downturn from 2008 to 23? That was when Gen X took the generational spending trends down, the most important single factor in our economy, okay? Well, the millennials are finally kicking in, and it should be on a 47-year lag instead of 46. That's what I've been assuming for a good while. And this strength in 2025 and after 24 against all this tightening would back this up. Says, yeah, no, they should be coming in and driving up fundamental demand again, which means, we shouldn't need stimulus, okay, in the future like we have for 16, 17 years, 29 trillion, again, record rates, okay? So that's what's actually happening. The question is, what does the stock market do with this other than rally naively on this weakening, knowing that it guarantees the Fed's going to cut and maybe 50 instead of 25, okay? So I have to look down at both levels of demographic analysis, not just the spending wave, which again, millennials just kicking in, but also workforce growth, age 20 when people enter and exit at 63. The baby boom has been exiting, okay, for many years, and just finally in 2024, last year, completed on average their exodus at 63 average age, and that's a pretty proven statistic now, okay? So that has been putting disinflationary and slowing pressure on the economy, okay, to offset this new millennial wave about to come in. And then they will continue in that and then have a dying wave all the way into 2040, starting really around recently too. So we've never seen this before in history, where a generation, particularly a large one like the baby boom, is not followed by the next generation that has always taken us to new heights in spending. The echo boom, because it was decent size and a long birth curve, takes us back to where the baby boomers were. So we only are growing on productivity, not demographics plus productivity. And an aging population because of the weight of the baby boomers, and older people do not drive productivity growth as much as younger workers, okay? So when I add this all up, and again, October issue is going to be an important one for subscribers, you know, with all this going on, these counter influences and demographics. Basically 2025 to 27 is a brief period here where the workforce growth is still pretty healthy because of the last numbers of millennials entering at age 20, okay? So that continues while the baby boomers continue to drag on the economy, and this first wave of millennials actually has a little bit of a drag before the next wave kicks in. So again, we have a more complex demographic scenario now. Again, I'm going to go through this in depth in the October issue, so subscribers be on the lookout for that. But I still say we need a crash here, obviously. Second biggest, longest, and 100% artificial. Never happened before. None of this. This length of bubble, totally artificial, never happened before, has to burst. This is the perfect time now with these trends, these kind of mixed trends in demographic. Late 25 into early to mid 2028 would be the ideal 29 to 32 scenario. And then people say, well, that can't happen, Harry, in a stronger demographic picture. Well, we just saw, you know, in the weakest demographic picture in history from 2008 to 23, we just saw the greatest stock boom in history, fueled by this 29 trillion. I mean, that I've shown in the newsletter, 7.8% average annual growth should have come just from the stimulus, and we got 2.2 to 2.5% average. That shows how weak the economy would have been, okay? And how important this stimulus was. So again, I think it's inevitable that something has to give here. I think it's still a good time to be out of stocks. Let's see what happens here in the next couple months. We are due for a peak here. This looks like a peak here, 5 waves and all types of charts across the board. So let's still be looking for signs of a crash during what would otherwise be not a great boom, but a modest boom from a less powerful generation that will last into 2037. And that's just the first wave of the millennials. There's a second wave that continues to take us more sideways with hopefully some productivity into 2054 before we see a major long-term demographic decline, which there's no signs. Birth rates are still going down. Immigration rates are going down, and under Trump, only more so. And a recession. This recession will definitely bring immigration down. So that's the picture. Good to continue to be cautious, stay out of stocks until something becomes more clear. And I am convinced that the next move is going to be down and strong. And remember, my unique research, again, nobody's done this, looked at every bubble burst in modern history since the early 1800s. First crash tends to be 40 to 50% in a matter of 2 to 4 months. I think it's averaged 42 in 2.6 months. So this next crash is not something to wait and see, well, I'll get out after it's clear. By the time it's clear, it may already be too late. So again, stay tuned. I'll keep you updated. I still think by year end, we could see a substantial downturn moving into place, and maybe even that first crash already over before Christmas.